Hello and welcome to this edition of CatoConnects. My name is Caleb Brown. I'm the Director of Multimedia here at the Cato Institute. Today we're talking about the big changes at the Federal Reserve and looking ahead to 2018. We're speaking with Tate Lacey. He is a policy analyst here at the Cato Institute in our Center for Monetary and Financial Alternatives. And so Tate, I want to say that, again, this conversation is going to be driven largely by your questions. So if you have a question you'd like to tweet that out, please use the hashtag CatoConnects or tag me directly in your question, and we'll get to it as quickly as we can. And also we'll be taking some questions via Facebook Live on the Cato Institute's Facebook page. Tate, welcome.
Thank you for having me, Caleb.
When it comes to the Federal Reserve, what was the biggest news of the past month for the Fed?
Well, the biggest news is that Governor Powell, now Governor Powell, is the chair nominee, Powell, and he is likely to be confirmed. He was the president's pick to succeed Chair Yellen, who has announced that she will be stepping down from the Federal Reserve upon confirmation of her colleague.
Okay, so what do we know about him, or how different is he from Janet Yellen? Janet Yellen inherited an entirely new policy tool, essentially, and has been defended it quite a bit. And we're really far away from the old days of monetary policy when these kinds of decisions were rooted in one policy tool. Now there are two. What do we know about Jay Powell?
So Chair Yellen actually was within the Federal Reserve System through the transition. Jay Powell was not. So as long as he has been at the board, we have had the new system that you rightly point out, the major change occurring in the dark days of late 2008. He was called in a lot of the press the continuation candidate when his name was being bandied about as a potential nominee. It was a somewhat of an interesting moniker for him, given that Chair Yellen herself was in the running. But he is widely predicted, and I think rightly so, to continue the plans that the Yellen Fed have put forward. Those plans are posted on the Fed's website. They call it their normalization plan. It comprises both a gradual rate increases and a reduction in the balance sheet. So particularly in his first year, he is unlikely to introduce any new policy.
Okay, well, let's take a look at that balance sheet to start with. This is from the FRED, the Federal Reserve Bank chart maker.
That's right.
This is the balance sheet for the Federal Reserve. What does this mean?
So you can see there was about 20 years of roughly steady growth on the Fed's balance sheet. They made most of their decisions at the margin, and as the economy was descending into the depths of the financial crisis and the Great Recession, you can see an immediate jump and then several further iterations, and then a last huge jump, which would be QE3. These were the asset buying programs that the Federal Reserve instituted to combat the crisis. And this is now the balance sheet reduction is going to bring this down considerably, is their intention, but it is worth noting that it will not go down to anything like a pre-recession trend level.
Okay, so the trend level was just like a very slight increase in the size of the balance sheet over time.
That's right.
And then at the end of 2008, a giant change. You're saying it will never see.
It will not go back down to what it was, even to the previous trend. And Federal Reserve officials give a couple of reasons for that. One is an elevated demand for currency, but they're also keen to keep a larger balance sheet as a potential tool to be deployed if and when we hit another downturn.
Okay, so the big headline news for the Federal Reserve just this week was a quarter-point increase in their target for the federal funds rate.
Correct.
We have some of the historical U.S. federal funds rate data here, and this does not look notable. The fact that we have a quarter-point increase in the federal funds rate doesn't seem like a very important thing.
Well, there's two ways to look at it. You're right to say that the magnitude of the rate increases doesn't look notable given how far they fell going into the Great Recession. What is notable, however, is the different way that monetary policy is now conducted. I think you referenced this early in one of your remarks. Previous prior to the Great Recession, monetary policy was conducted in the interbank market, is what it was called. And the federal funds rate was set by mostly domestic commercial banks lending reserves. You can think of that as just the cash that banks hold at the Fed to one another. And these reserves were, of course, used to fund loans, the bank's expansion as they supplied credit to the economy. That has totally changed. As we went into the crisis, you can see that previous chart, the balance sheet grew. An interbank market that operated as such would no longer allow the Fed to, as they would say, control the short-term rate, particularly when they wanted to move it up, as they've now done 5 times, starting in December of 2015. So now when they raise interest rates, they're no longer adjusting that federal funds rate, that rate that banks pay one another to borrow reserves. They post-administered rates. So you might hear the term IOER, that's interest on excess reserves. And they just announce it. And then they announce a separate rate, which is, this is maybe a bit technical, but a reverse repo rate, which sort of in between those two, you can just think of it, there's an effective federal funds rate. But the players in that market have dramatically changed. And Chair Yellen recently, now that she knows that she's no longer going to be at the board, has increased her defense of this system. But you can think of it as essentially the Fed, part of the United States government, paying these banks to just sit idly on these reserves. So this massive increase in the balance sheet, well, a lot of that money that's been created is sitting with domestic commercial banks, and they just receive interest payments on it.
Okay. We have a question here from I Am Not. Thank you. The question is, did Yellen's curtain call just knock the wind out of the U.S. bullish stance?
Well, I guess maybe that in some ways remains to be seen. I think the notable sort of curtain call, I'm assuming the question is referring to some of her answers during the FOMC press conference on Wednesday. She did, I think the notable part, more so than she had previously as Fed chair, voice her concern over the debt levels and how much the United States is borrowing. Now, of course, this is not really a policy decision that's in the purview of the Federal Reserve. So during her tenure, she didn't talk much about it. But I think by and large, she reiterated the points that she's made. I think the plans that have been developed in the Yellen Fed, as I think I indicated earlier, are likely to continue barring sort of economic changes under a Powell Fed.
Okay. You mentioned that Chair Yellen, to the extent that she has recognized that she's no longer going to be at the Federal Reserve, has been more defensive or defended more strongly the system we have now. The system we have now is essentially 2 policy levers where there had been one before. One is setting the federal funds rate and trying to influence other interest rates through that rate. Mm-hmm. The new one is paying interest on reserves. What happens when those two are at loggerheads? Because I can imagine there will be a circumstance where one is going to make the other less effective, and it seems that we're in uncharted territory with respect to giving the Federal Reserve more than one tool to try to influence the economy.
Yeah, and you're exactly right when you point out the uncharted territory about this system. The Fed has a balance sheet reduction plan, which they have indicated, most Fed officials, that it will go on gradually and in the background. But when they make these statements, they always caveat it that as economic changes may occur, they may redeploy the balance sheet. But they have essentially no experience, but for this rapid increase over the last 10 years, of using the balance sheet as a tool of monetary policy. They claim that they want to get back to, quote, normal interest rates. But as you also point out rightly, they're doing it in a very, very different way by paying most of the banks that used to participate in this market basically to sit on the sidelines. So you can think about the pre-crisis operating framework as they would adjust the amount of reserves. So you can think about that as changing the balance sheet and to adjust the proper interest rate. So those things more or less moved in concert. They were part of the same apparatus, and that's totally gone. So as they continue, let's assume for the sake of argument, that I think the market implied rates right now after the FOMC meeting call for another 3 increases in these interest rates next year. Well, that's going to make holding reserves more attractive because you'll be getting higher interest payments as they make successive rate hikes, the first of which is looking like it'll be in March. Well, that's going to make banks want to hold on to reserves more, not less, which, all things being equal, is going to be a contractionary force on the economy. And it's unclear if the Federal Reserve, particularly Jay Powell when he takes over, has thought through that additional contractionary pressure while they're, of course, increasing interest rates, which, again, all things equal, puts a little bit of downward pressure as well.
And it's interesting to me that we're in a situation that was in part a reaction to the financial crisis, which was itself partially driven by regulatory policy. And the response from the Federal Reserve was to dramatically increase liquidity into the system. And
then pay for it not to actually go into the system.
Right, but yes, and pay for it not to go into the system. And here we are 9 years later, and the Federal Reserve now wants to assume that their ability to keep banks holding on to this cash is just going to be a permanent policy tool. Is the view that this is just a new tool and we're just going to keep using this tool, and yeah, we're in uncharted territory, but we need this authority?
Well, they certainly haven't articulated any alternative to that. So it seems that they're prepared to continue this new regime. And again, Chair Yellen has increased her defense of it quite a bit, calling it on several occasions the key tool of monetary policy, the only way to maintain any monetary control. Now, of course, it needn't be that way. They could make a bigger adjustment to the balance sheet and try to transition from this current, the technical jargon would be a floor system, back to a corridor system where all the market participants were back in the federal funds market. It was a much more market-driven interest rate, and the Federal Reserve was simply adjusting the quantity of reserves in the system as a whole. They've as yet given no indication that they have a desire to return to that.
All right. If you have a question for Tate Lacey from the Cato Institute Center for Monetary and Financial Alternatives, you can tweet it at us with the hashtag CatoConnects, and be sure to tag me at CO Brown, and we'll try to get to as many of those questions over the next 15 or 20 minutes or so. So what should the Federal Reserve be doing? It should be, I presume, correct me, should be shrinking the balance sheet dramatically so that this other policy tool is rendered irrelevant.
Yeah, well, they are going to do that. They've established this system of sort of gradually increasing cap. So prior to the balance sheet reduction announcement, what they would do is when a security, a bond matured on their balance sheet, they would reinvest those proceeds, and that essentially kept the balance sheet at the same level for a while. They've now set caps. They'll allow a certain amount to roll off and only reinvest the proceeds above those levels. And this is in an effort to have a smooth transition because they have different maturity dates across their entire portfolio, and they don't want to be in a situation where there's sort of very little roll off at one point, then a lot. They want to get that sort of potential lumpiness out of the system. So it is going to go up. They do have some target range. They're very coy about where it's going to be, but what they're not mysterious about is that it will be quite a bit larger. The question will be, is that final resting level, that level of the balance sheet, going to afford them the opportunity to transition back to the federal funds market that we had before the financial crisis? That is the key question. I think they ought to go back to that kind of a system. I don't think we should have these twin levers, particularly one of which the Fed has very, very little experience using. I don't think we want to find out what a balance sheet wind down looks like in the midst of a crisis were we to go into another downturn. But again, when a Fed official is pinned down on what the future of monetary policy is going to look like, it is going to stick with interest on excess reserves.
Okay, a question here from Sir Jeffrey Lebowski. Thank you, dude. When will the Federal Reserve allow an audit of the gold in the New York Fed?
Well, I don't know when they'll allow the the goal to be audited, but there are calls for increasing audits of the Fed. Now, it does need to be stated that the Fed is audited in a number of ways, but there are particular parts of its implementation and the kind of business it conducts that are not part of that. So namely, most of the monetary policy decisions, a lot of those deliberations, they do release transcripts of those meetings 5 years on, but there are certain communications between governors, between regional bank presidents that are not shown to the GAO. The Fed is very interested in not releasing that. It would be an increase of transparency. But in terms of the conduct of monetary policy, it does remain to be seen that there are potentially better changes than, say, auditing some of these portions that are as yet uncovered. And we could talk about some of those if you want.
Okay, yeah, you mentioned that the Fed is audited to some extent, but it's mostly here are our books. Ben Bernanke and Ron Paul had this conversation many times over several years in which they were clearly talking about two different things.
Yeah, so the defense typically is that they're audited like a financial institution, and that which they publish their balance sheet weekly. You can see what their assets and their liabilities are. So that does get audited to verify that those weekly publications are true and accurate reflection of the Fed's holdings. So I think that's the kind of defense that Bernanke points out. When people say they want increased audits, they're talking more about some of those deliberations, getting a better sense of how they're conducting policy. And I think Federal Reserve officials, when they push back against that, there's a question of politicizing some of those decisions. So to give an example, maybe you could think about if there was more political pressure, say during Paul Volcker's tenure, when he was trying to wring inflation out of the system. Now that's largely today, I think rightly so, thought of as a good thing, a series of decisions that got the high destructive inflation of the 70s out of the financial system. It went a long way into inducing what we call the Great Moderation. That was a lot of Greenspan's tenure where we saw low, stable inflation, good economic performance. But you could imagine while he was raising interest rates dramatically to do that, to get that inflation out of the system, you can read the news of the day. Members on the Hill were displeased with some of those moves. And that increased tension, if the Fed had to answer for everything in real time, could have been a problem. We would not want to have had inflation persist.
Well, and I think, to his credit, and I think we should give him as much credit as we can, I think Jimmy Carter knew this at the time. He knew that this was the path that was going to be taken, and as you know, whether or not you want to politicize things, people do choose chairs of the Federal Reserve based on what they think will be politically advantageous in the window of their political careers. And Jimmy Carter seemed not particularly concerned with what would probably be negative impacts on his own electoral prospects.
Yeah, and the late Alan Meltzer, who wrote a tremendous history of the Federal Reserve, has pointed this out, that during the interview, Paul Volcker said to him, "Mr. President, I intend to get inflation out of the system." And to your point, Carter said that's exactly what we need to have happen. I think in these kinds of instances, you do want the central bank to have a longer time horizon which they're adjusting policy than, say, some people on Capitol Hill, particularly members of the House who are almost, in this day and age, almost always running for office. So you do for the Federal Reserve to look past one election cycle is a good thing. But again, increasing transparency at the Federal Reserve is also a good thing.
All right. So you're a fan of nominal GDP targeting.
I am.
Explain what that is briefly.
So nominal GDP targeting would be a separate target for the Fed to pursue. So right now they have this rather ambiguous dual mandate which calls for maximum employment and stable prices. And as we mentioned, in ordinary times they had only one policy tool, the interest rate, so it was hard to balance these things. And what that's created is a world, or what it had then, was a world in which you could get criticisms in a lot of different directions of whether the Fed was achieving its goals, this dual mandate. Are we really at maximum employment? You know, the Fed has continually called for, they think the unemployment rate is at a natural level, and yet it continues to decrease. A nominal GDP target, you can think of it just simply as the sum of the real growth rate of the economy and the inflation rate. So it's basically just the economy measured in dollars without any adjustments. And what you would want to see is the Fed set its monetary policy in such a way that growth in nominal GDP adjusting year over year is a stable trend path, which can be done.
All right.
So the next question that typically comes is, what would they do to accomplish this? It's a different system in terms, you could compare it to something like the Taylor rule, which has sort of a mechanical prescribed adjustment in the interest rate given economic variables. Nominal GDP targeting would not have anything quite that mechanistic. So the way in which you would do it is the Fed would set its monetary policy, and this again, it would be on a sort of medium-term time horizon, so that what they were forecasting was stable growth in nominal GDP. You can look at some of the summary of economic projections right now. Their longer-term projection shows for not a stable path. They show a slight burst of nominal growth in the next year or two, but then the longer-run trend is lower than that. A successful nominal GDP targeting regime, when you looked at those longer-term forecasts, they would be anticipating the right growth rate.
Okay, so when the public, fully apprised of the tools that are being used or the measurements that are being used to set future nominal GDP, they can observe that as data is released. So, the expectations of market players in the economy is based upon things that are broadly available to the public. So they would not have to, I suppose, wonder what's going on in a room at the Federal Reserve when it comes time to set interest rates, and
if it was done properly, again, it would be on this what we call sort of a medium-term time horizon. So it would be several years out. And what that would afford all these economic actors, whether it be that in business or consumers, is that you would have an anticipation of just how much spending was going to be going on in the economy. And I know spending can sometimes become a sensitive subject, but we're not talking here about using artificial spending to boost anything in the short term. You would anticipate just how much money was going to be turning over in the economy, how many goods and services were being purchased. And that would sort of put a firmer floor under your own financial and economic decisions. You contrast it with what happens when nominal GDP doesn't grow on that trend, or when it takes a severe deep dive, as it did in the financial crisis. It was down something like 8%. You could think about that in a certain way, that the economy as a whole had 8% less money to satisfy its financial obligations than it would have otherwise. And you think most debt in the country is not indexed to anything. They're nominal debts. So when you lose 8% of your ability to repay things, you end up in a pretty severe financial contraction, which is exactly what happened.
All right. So what should we expect the Federal Reserve to do in the next few years? Is there any appetite for a shift, or at least a more transparent, rule-based monetary policy?
We probably shouldn't expect a explicit adoption of a nominal GDP target, though were it to come, I and a great many others would welcome it. However, Chair nominee Powell has expressed some openness to using rules in the conduct of monetary policy, and he's actually highlighted two different ways that he's open to it. One is as helpful guides to making decisions in real time, which of course is beneficial. But even I would say more important than that, he is open to using rules as benchmarks to judge the past performance of monetary policy and hopefully learn from some of the decisions they have made. So if you want to think about something explicit that we've gone through recently, in January of 2012, the Federal Reserve sort of clarified its mandate, not just for stable prices, but adopted an explicit 2% inflation rate target, which they have chronically undershot since then. Now, we don't need to necessarily debate all the merits of inflation targeting as a monetary policy regime, but its problems to hit that is they should be learning something, and they've become increasingly exotic with their reasons for why they haven't hit it. But if you were using some kind of a rule, you might look back on this chronic undershooting and say, well, what would another rule have called for policy-wise? And that would help you, I think, going forward.
To what extent does nominal GDP targeting, if it were to be implemented, to what extent and how does it constrain fiscal policy? One of the big benefits of a gold standard that people like Ron Paul would like to point out is, look, you don't get the profligate welfare and warfare states without a monetary policy that isn't that doesn't constrain fiscal policy. In fact, accommodates a very expansionary fiscal policy.
The gold standard sort of made it much harder for a country to greatly expand its money supply. There was a self-equilibrating mechanism built into that system. Nominal GDP targeting with regard to fiscal policy, in my view, there would be a lot of benefits. One thing, it would depoliticize it to a great deal. You would no longer – it would basically take the air out of the argument that we need to boost fiscal policy for any and all reasons as a way just to pump spending up. Because, again, the overall spending in the economy, the overall dollar exchange in the economy would be growing on a stable path. So if you recall sort of the news of the day, there were some economists saying, well, it really doesn't matter what the government's going to spend money on. Any project under the sun that's shovel-ready is of an economic benefit. Nominal GDP targeting basically would render that argument moot going forward.
Okay. Any closing thoughts before we wrap up here?
I think nominal GDP targeting, as long as we're singing its praises, it deserves to be said that the one main reason why it's superior is it handles shocks to the economy much, much better. Both negative and positive shocks. So the Federal Reserve were to implement this. You think about surging oil prices, it would handle that much better. It would not create double contractions. And also, were we to see gains in productivity, which I think everybody would like to see, a nominal GDP targeting regime, as real growth were to increase, that would do would be to dampen inflation rather than sort of overreacting in a different direction.
All right. So changing gears just a little bit, investors have gone from ignoring Bitcoin to talking about how it's a scheme, to saying it's a bubble, to buying it as quickly as possible. Mm-hmm. And so based on what you know about it, there is a strict limit on the number of Bitcoins. There are other cryptocurrencies that grow at different rates mm-hmm. and have different kinds of different arrangements in terms of the tools that they enable. What do you make of the fact that this had such a meteoric rise, and by any conventional standard, you would say that's probably a bubble in this asset?
Well, I think as we've all learned, calling something a bubble is tough to do. Both
right. There are
the level and the timing.
Right.
So I'm not about to try to put my mark down in there.
Right. No. Let me be clear. There's no way to anticipate a bubble, and if we check a bunch of boxes on something and say, oh, this makes it a bubble, then of course it wouldn't be, right?
Mm-hmm. Sure. And I think in terms of what we've been talking about with the Federal Reserve, Chair Yellen got quite a lot of Bitcoin questions during her last FOMC press conference just a couple of days ago. And there's more and more noise that the Federal Reserve might want to be getting involved in some kind of a regulatory aspect. Bitcoin has had this meteoric rise, but the overall size of the cryptocurrency market doesn't seem to be all that large juxtaposed to the economy as a whole. I can see nowhere where it's posing any systemic risk other than the investors who, again, capitalism is a profit and loss system. So if those folks want to pour in at high valuations, then they ought to be expected to take the downside should it go down. I think what we don't want to see is an overbearing footprint by the Federal Reserve or somebody else like that. I think despite the rise of Bitcoin and maybe a few other coins recently, it's still a market that I would say is in its infancy, and it ought to be allowed to grow and sort of organically develop. I think it's an interesting thing to watch. Those people who want to play in that market ought to be able to do so. I think Chair Yellen called it a highly speculative asset. It certainly is an asset in my view right now. It doesn't seem to have the main properties of money at the moment. But what I don't want to see is some facet of the state become overbearing for it. I think that would be something that we ought to not see, and particularly the Federal Reserve. This isn't a political comment, but it's a conservative institution in how fast it moves and what it changes. So you don't want something with that level of bureaucracy and that tone of a bureaucracy to get into a market that is this young and potentially vibrant.
All right. Tate Lacey is a policy analyst in the Cato Institute Center for Monetary and Financial Alternatives. Thank you very much. One housekeeping note in this holiday season, if you are a listener to the Cato Daily Podcast, we have started a new program, the Podcast Sponsor Program. So if you go to cato.org/podcast sponsor, you can find out about how to support the Cato Podcast. And of course, CatoConnects often ends up as a Cato Daily Podcast. And if you're joining us late, you can subscribe to the Cato Daily Podcast, and you'll have this conversation available to you. Thank you to Tate. Thank you for watching. Thank you for your questions. If you have any comments, you can tweet those at me or email them to me at my email address here at the Cato Institute, and we'll talk to you again next time.
Thanks, guys.